You may have heard a lot of talks about CFDs, but what does it actually mean? Hi, my name is Lisa Hodges, an investment manager at BF Solutions Group, with more than 20 years of experience across the finance sector. Today, I would like to introduce you all to CFDs and what do they stand for. What does CFDs stand for? CFDs is an abbreviation for Contract for Differences, CFD. A more simplified explanation, it is a contract between a buyer and a seller that stipulates that the buyer must pay the seller the difference between the current value of an asset and its value at contract time. How does CFDs trading work? With CFD trading, you buy or sell units of a financial instrument, depending on whether you think the price will go up or down. It is basically an agreement between an investor and a CFD broker to exchange the difference in the value of a financial product, securities, or derivatives, between the time the contract opens and closes. CFDs offer traders exposure to a wide range of global markets, including currency pairs, Forex trading, stock indices, commodity shares, and cryptocurrencies. How do I make a profit of CFDs? By speculating whether the price of an asset is going to rise or fall. The accuracy of that prediction largely determines whether a trader makes a profit or a loss. Terms associated with CFDs. Here are a few words you will encounter when dealing with CFDs. Buy is the process of purchasing a financial instrument. If you were to anticipate a rise in the market, a buy would mean to go long. A buy is also made when closing out an existing sell position. Go short. Sell. Selling means to go short, typically in anticipation of a falling market. You would also make a sell to close out an existing buy position. Spread. The difference between the buying and selling price. Short position. A client is said to be short if he or she has an open sell position in the market. Going long. When a buy position is taken out, it is referred to as going long. Volatility. A term used to describe and quantify the relative movement of a given market in the recent past. Ask price. The ask price is the specified price at which you can purchase CFDs. It is always the higher of the two prices quoted and is called the ask or ask price. Bid price. It is the price at which you can sell the CFDs. Dividend. The payment made to the shareholders by a company representing the distribution of company profits. Hedging is the action of reducing the risk of an outright position in one market by taking an opposite position in a similar or derivative market. Liquidity, the ability of an asset to be converted into cash quickly without any price discount and any restriction to the size of the trade. Liquidity also refers to a market that is regularly traded. Now that we have gotten familiar with the wordings associated with CFDs, we would like to take a look at the pros and cons of CFDs. Pros. Liquidity. CFD prices mirror directly what is happening in the underlying market. This means that CFDs provide you access to the liquidity in the underlying market, in addition to the liquidity offered by the CFD provider. Low transaction costs. Brokerages using CFDs is usually much cheaper than buying shares through a full-service broker. Ability to trade international markets from one account. Many CFD providers offer CFDs on international shares, as well as things you aren't normally able to trade, like gold, silver, oil, indices, sectors, commodities, treasuries, etc. Transparency and ease of execution. receive interest on short positions, the ability to trade any time frame with no fixed expiry date, and many more. While reviewing the pros, it is also important to bring to your knowledge the cons associated with CFDs. Cons. Trading CFDs can pose a higher risk than trading shares. Even though you don't need to deposit the whole value, you could still lose your initial margin. Ease of access and low capital requirements can lead to overtrading. Leverage can be a double-edged sword. CFD investors have limited rights compared to a shareholder. That being said, it is possible to profit of trading CFDs due to the fact that they give you the opportunity to profit from both downwards and upward price moves. And you can use leverage to scale up on risk return. Always remember the risk factor is always there when dealing with investments, and so you should never commit financially without the proper knowledge and guidance. For more information or a free consultation regarding investments of CFDs, do not hesitate to contact me today at Lisa_Hodges at bfsolutionsgroup.com.